Welcome back to the Deep Dive. Our mission here is to take these really complex, often dense topics, the stuff that keeps lawyers employed and policymakers, well, confused, and just break them down.
Right, into the essential knowledge you need to be truly well-informed.
And today we're diving into a subject that I think most people only really understand in the abstract. We're talking about foreclosure.
It sounds simple, right? Someone misses a few payments, the bank takes the house. But the reality is, foreclosure is less about a simple transaction and more about executing this massive, heavily regulated, and sometimes, frankly, archaic legal process.
So this deep dive is going to explore the mechanics, the surprising varieties in just the U.S. system alone, and, of course, the profound human cost that's often hidden.
Exactly.
We've put together a stack of sources, legal analyses, a lot of economic studies, policy papers to guide us through this. And I think the very first thing we have to nail down is the fundamental legal function. I mean, what is foreclosure beyond just getting a debt paid?
So, formally, foreclosure. It's the legal process where a lender, the mortgagee, or, the secured creditor, forces the sale of collateral, like a home,
To recover the money.
to recover the outstanding loan balance after a borrower defaults. But, and this is the key, the core legal action we're really focused on is the termination of the borrower's equitable right of redemption.
Okay, let's unpack that, because that right there feels like the aha nugget, the equitable right of redemption. It sounds like something out of a Dickens novel.
It's very old, it's deeply historical.
So what is this right, exactly? And why does a lender need this whole long, formal process just to get rid of it?
Well, you have to go back centuries. Courts of equity recognized that loans were often these highly asymmetrical relationships. The lender held all the power. So they decided that even if a borrower defaulted on the specific repayment date, they should still have the ability to pay the full debt plus costs and get their property back.
So even after default?
Even after default. And that ability is the equitable right of redemption. For the lender, it acts as this permanent, nagging legal risk.
So let me get this straight. Even if the borrower misses payments for, say, 6 months, and the bank technically has a right to take the house, this historical right, it just sort of hangs over the property.
It hangs over the property, exactly. As long as that right exists, it creates what lawyers call a cloud on title.
A cloud on title.
The lender might possess the property, but they can't guarantee full, clear ownership to a future buyer. I mean, imagine trying to sell a car where the previous owner could legally show up a year later with cash and demand it back.
Right. Nobody would buy it. It's an impossible sale.
You'd never get a clean sale.
So that clarifies it. The whole complex foreclosure process isn't just about starting a sale. It's a required legal mechanism specifically designed to, extinguish that historical right.
To terminate it, yes. Once the process is complete, the lender finally gains both the legal and equitable title in what's called fee simple.
Meaning undisputed, clear ownership. They can sell it without worrying about that old owner coming back.
Precisely. It's the legal clearance process. If a lender tries to just bypass the proper foreclosure steps, they risk a huge lawsuit later from the original borrower claiming their equitable right was never properly extinguished.
Which would void the sale to a new family.
It would void the sale. It would be a catastrophe for everyone.
And crucially, this isn't just about the big banks and residential mortgages, is it?
That's a key point people often miss. Foreclosure is the remedy for any secured debt tied to the property. It applies whenever a lien holder needs to get their money back.
So who else are we talking about?
Well, mortgages are the common example, sure. But you could face foreclosure from, say, a government agency for overdue property taxes, a contractor who puts a mechanic's lien on your house for an unpaid kitchen remodel.
Or even your HOA.
Or, and this is increasingly common today, your homeowner association for overdue dues or assessments. Any lien can trigger it.
Okay, so now that we get the core function, it's about clearing the title. Let's dive into the fascinating variability within the U.S. system.
Right.
Because our sources confirm the flavor of foreclosure you experience depends almost entirely on which state you live in. We've identified 3 primary legal types.
Yes. And the U.S. system is split, really, between court-involved and non-court-involved methods. Let's start with the one that provides the most oversight, the one that's mandatory in almost half the country. Judicial foreclosure.
Judicial. This one sounds like it is, a a full-blown lawsuit.
It is. It absolutely is. The process requires a sale under direct court supervision. The lender initiates it by filing a civil lawsuit against the borrower, naming them as the defendant.
And the court is involved every step of the way.
Every major step. It's available in every state, but it's the only required method in about 20 states, including huge population centers like Florida, Illinois, and New York.
So for the borrower, what are the practical implications of a judicial process? More time, more rights.
Both. The borrower gets due process. They're formally served with the complaint. They have the opportunity to file defenses, which we'll definitely get into later. And the process is lengthy. I mean, it often takes 18 months or more from the first missed payment to the final auction.
And a judge or some kind of court official oversees the actual sale.
Yes, a judge or an appointed referee makes the final decision, supervises the sale, and then manages the distribution of the proceeds.
Okay, let's talk about that distribution. Who gets paid first? It's not just the bank, right?
No, lien priority is absolutely key here. The proceeds are distributed in a very strict order. First, the costs of the sale and court fees get covered.
Makes sense.
Second, the mortgage that started the whole thing gets paid off. Third, any junior liener holders, think second mortgages, HEO fees, those HOA liens, they get paid in the order they were recorded.
And if, by some miracle, there's money left over.
If there's any surplus at all, only then does it go back to the borrower, the mortgager. The whole thing is designed for transparency, but that delay, it adds significant costs.
Okay, so let's contrast that with the system that's really common in the Western U.S. and a lot of the Sun Belt. Non-judicial foreclosure. People also call it foreclosure by power of sale.
And this is the favored system of lenders, and for a very good reason. It authorizes the sale of the property by the mortgage holder, usually through a third-party trustee, without needing court supervision.
So no judge, no lawsuit.
No judge. But it's only possible if the loan documentation, either the mortgage or, more commonly, what's called a deed of trust, specifically includes a power of sale clause.
This sounds less like a state action and more like a private contractual remedy.
That's exactly how the courts view it, which has massive implications for borrower defenses, as we'll see. For the lender, the benefit is just undeniable. It's generally much faster, sometimes done in as little as 90 to 120 days, and it's way cheaper. They avoid all the court filing fees and the long legal battles.
And lenders have been pushing for this for a while.
Oh, yeah. They began pushing for this reform way back in the mid-19th century. Their argument was that judicial foreclosure was, quote, clogging state dockets. Today, in states like California, Texas, and Washington, this non-judicial process is absolutely the standard.
Okay, and then there's a third, you said, a highly specialized and pretty rare version. Strict foreclosure.
Right. Strict foreclosure is a bit of a historical anomaly. It's only really used in a handful of states like Connecticut and Vermont.
So what makes it so different, so strict?
What makes it unique is that if the lender wins the case, the court orders the borrower to pay the entire debt within a specific, very short period. We're talking maybe 30 or 60 days. If they fail to pay, the lender just gets full title to the property.
Wait, they just take the title? There's no public auction? How does that work if the property is worth way more than the debt?
That's the crucial point. Because there is no sale, the lender keeps the property and any equity in it. They are not obligated to pay the borrower the difference.
That seems unfair.
It would be. And to protect the borrower's interest, courts will generally only permit strict foreclosure when the value of the property is definitively less than the debt owed. In other words, when the property is underwater.
Got it. So if there's substantial equity, the court would be almost forced to order a judicial sale instead.
Almost always. They have to ensure that equity is protected and potentially returned to the homeowner. It's a very limited tool for a very specific situation.
That really sets the geographical stage for the process. But before the sheriff's auctioneer or the trustee can even start prepping the sale, a huge administrative step has to happen. And it's governed by what is probably the most powerful piece of fine print in your entire mortgage.
The acceleration clause.
Acceleration is. It's the nuclear button in the lender's arsenal. When you sign that, that huge stack of papers for your mortgage, typically in section 16, 17, or 18 of the standard document, you agree to this.
And what did I agree to? You agreed that if you break a term or covenant of the mortgage, the lender doesn't just ask for the payment you missed. They declare the entire debt immediately due.
This is where it gets really interesting. So I miss my, say, $2,500 monthly payment. Without acceleration, I owe $2,500 plus late fees. With acceleration, what happens?
It immediately declares the entire payable debt due. So if you had $300,000 left on your mortgage principal, you now owe $300,000 plus all the accrued interest, late fees, property inspection costs, attorney's fees.
You owe it all right now.
Right now. It transforms what was a manageable, if difficult, cash flow problem into an instant financial impossibility for most people.
And it's not just missing payments that can trigger this, right? What are some of the other, maybe sneakier breaches that can cause acceleration?
Any action that attempts to transfer ownership or an interest in the property without the lender's written consent is often a trigger.
Why is that?
Well, it's all about protecting the lender's collateral. So examples would be executing a lease option agreement where your tenant agrees to buy the house down the road, or entering into a land contract, even transferring the title to a family trust without permission. The lender needs to maintain their priority against you, the borrower they vetted. Any ownership change without telling them breaches that trust, and bang, acceleration.
So once the lender decides to pull that trigger, the clock starts ticking very, very loudly. What are the formal, mandatory documents they have to serve to let the borrower know this is happening?
The first and most crucial document is the notice of acceleration. It's also called a demand letter or a breach letter.
And what does it have to say?
It is to state the breach precisely, whether it's missed payments or an unauthorized transfer, and it must state the exact time period the debtor has to reinstate or cure the loan.
What are the typical cure periods, and how do they make sure the borrower actually gets this critical document? It's not just an email, I assume.
Oh, no. While it varies, the standard minimum cure period is usually 30 days for residential mortgages. For commercial properties, it can be as short as 10 days. And to satisfy the legal requirements, these letters have to be sent by both certified mail, which gives the lender proof of attempted delivery, and regular mail to all the relevant addresses for every single person who signed the original note.
And they have to provide a specific financial breakdown of what is owed, which, as you mentioned, is more than just the principal, right?
Absolutely. The lender must include a comprehensive payoff quote, typically estimated 30 days from the date of the letter. This is often packaged within an initial communication letter, which is mandated by the Fair Debt Collection Practices Act, or FDCPA.
Okay, let's define that for everyone. What is the FDCPA, and why does it matter here?
The FDCPA is a federal law. It's designed to eliminate abusive and deceptive collection practices. It requires debt collectors, which a foreclosure attorney or a servicing company becomes at this point, to provide specific disclosures to the debtor within 5 days of that first communication.
And the payoff quote is part of that.
It is, and it details not just the principal and interest due, but also any outstanding unpaid property taxes, forced place insurance, and all the accumulated delinquent payments.
So the final bill the borrower receives is almost always way higher than they were expecting, because it's rolling in all these third-party fees and taxes the bank had to cover to protect its interest.
Precisely. If the borrower tries to cure the loan, they're not just paying back a few missed mortgage payments. They have to pay the full accelerated balance, or, what's more common during the cure period, pay everything except the remaining principal to deaccelerate the loan and get back on the original payment schedule.
We briefly touched on older or maybe specialized mortgages that might not have this powerful acceleration clause. If they don't have it, how paralyzed is the lender?
They are severely limited. I mean, if there is no acceleration clause, the lender can only sue the borrower for the payments that are currently past due. They can't demand the whole loan back.
So what are their options?
Their options are pretty bad. They either have to wait years until the loan naturally matures and all the payments come due, or they have to try and convince a court to force the sale of only a small piece of the property to cover the past due payments.
I see. That explains the need for it from their perspective. It's hard to run a lending business if you have to wait 20 years to get your money back from a defaulting borrower. The acceleration clause is really the necessary prelude to the entire modern foreclosure landscape. And speaking of speed and efficiency, this whole push for immediate debt recovery through acceleration is exactly why lenders then focused on changing the judicial system itself. This leads us right to the rise of non-judicial foreclosure starting back in the mid-19th century.
Right. The sources show the financial industry's reasoning was twofold. First, they wanted to lower the cost of credit by avoiding these long, drawn-out court battles.
Second,
and this is interesting, they argued it would be less traumatic for defaulting borrowers by avoiding the interim effects, the terror effects of being formally sued and dragged through the civil court system.
Let's break down the actual steps of that non-judicial process, the statutory procedure you'd see in a place like California. How does the process go from that breach letter to the sale, without a judge ever getting involved.
So once that cure period we talked about expires, the mortgagee, or often a private foreclosure trustee, gives the debtor a formal notice of default, the NOD, and a notice of their intent to sell the property.
And this NOD is a public document.
It is. This NOD is a state-specific document, and it's recorded against the property with the county recorder's office. That recording acts as the public announcement that a sale is coming.
So who's the state supervisor here if there's no judge?
In the majority of non-judicial states, virtually the only government involvement is the county recorder, and their role is purely ministerial.
What does that mean, ministerial?
It means they just record the NOD and the eventual trustee's deed of sale. They make sure the format meets basic legal standards. They are specifically denied the power to decide whether the sale should proceed. It's basically a contractual execution, not a state-mandated judicial action.
That said, our sources did flag one notable exception, where a government official is involved, even in a non-judicial state. Colorado.
Colorado is unique. It requires the use of a county public trustee, who is a government official, to carry out the whole foreclosure process instead of a private corporate trustee. It adds a slight layer of public accountability, but the legal basis is still that non-judicial power of sale.
So once all the notices have been served and the time periods have run out, the process culminates in the foreclosure auction. This is where the competitive balance gets, well, fundamentally skewed by one simple rule: the credit bid.
It's a huge, huge operational advantage for the institutional creditor. The auction is public, but the lender, the secured creditor, is the only party legally allowed to make a credit bid.
Okay, explain the practical reality of a credit bid versus a cash bid.
So let's say the borrower owes the bank $300,000. The bank can bid up to $300,000 without spending a single dime of actual cash. They're bidding with the outstanding debt they already hold.
And everyone else.
Everyone else, investors, individuals, speculators, they have to present cash or a cash equivalent, like a cashier's check, immediately to the auctioneer the second they win the bid. This severely limits who can compete, and it often just ensures the lender gets the property back if the price doesn't go above what they're owed.
So if an outside investor wins, they pay cash, and that cash pays off the debt. But if the bank wins with its credit bid, they just take ownership and wipe the debt off their books against the value of the asset.
Precisely. The highest bidder takes ownership, and the new owner gets the property clear of the former borrower's interest. However, as you rightly flagged earlier, they don't necessarily get it free of all leasing.
Right. So what kind of lease can survive a foreclosure sale?
Any leasing that is superior to the lien being foreclosed on will survive and stay on the property, which the new buyer then inherits.
What are the common ones?
The most common examples are unpaid property taxes. Those always maintain priority. Or a senior mortgage if the foreclosure was started by a junior lien holder, like a second mortgage. That's why cash bidders have to do a ton of title research before they ever raise their hand.
This brings us to borrower defenses. For those borrowers who try to fight the process, their success rate and even the kinds of arguments they're allowed to use are entirely dependent on which legal system they're in.
It creates this huge legal disparity. In judicial states, the borrower has the powerful standing defense available to them.
Standing, meaning the right to sue.
Right. Because the lender is a plaintiff in a civil suit, they have to prove they have the right to be there. We saw numerous successful dismissals in judicial states like Ohio and in certain Colorado courts where the alleged lender just couldn't produce the original promissory note. They couldn't prove they were the real party in interest.
Which makes sense, given how rapidly loans were being securitized and sold all over the country. Sometimes the bank filing the suit isn't actually the bank holding the note.
Exactly. It's a fundamental failure of due diligence on the lender's part. But now, switch to the non-judicial states. There, the borrower often tries to invoke the due process argument, claiming the process violates their constitutional right to fair treatment.
And courts in those non-judicial states like California, they largely reject that argument. Why?
Because the constitutional right to due process only applies when there is a significant action taken by a state actor.
A government entity.
A government entity. Since the non-judicial process is executed privately by the lender or a trustee, with the county recorder just acting in that ministerial role, courts have repeatedly ruled that there isn't enough state action to trigger constitutional protection. They argue the borrower willingly agreed to the power of sale clause in the deed of trust.
So just by agreeing to that clause in the paperwork, the borrower essentially waived their constitutional defense against the process itself.
That is the legal reality in those jurisdictions. Courts have been quite clear. If debtors desire the additional protection of the formalities of judicial foreclosure, they should have secured a loan that didn't include the power of sale.
Wow. Okay, now let's talk about the paradox that really highlights the institutional bias in these systems.
Yeah.
The tender rule. This affects states like California, Georgia, and Texas.
The tender rule is just. It's astonishing in its effect. It's based on this old legal maxim, he who seeks equity must first do equity.
Okay.
What it means is if a borrower wants to legally challenge an allegedly wrongful foreclosure, say based on fraud or improper notice, they must first make legal tender of the entire remaining debt balance prior to the sale.
Wait, hold on. You have to pay off your entire mortgage in full just to reserve the right to sue the bank for improperly trying to take your house. That seems fundamentally contradictory.
It is the ultimate catch-22. As legal critics have noted, if the borrower had the cash available to promptly pay off the entire balance, they wouldn't be facing foreclosure for missing payments in the first place.
It makes legal challenges basically impossible for the very people the law is supposed to protect.
The people without deep pockets, exactly.
And if they don't comply, even if they can later prove the bank was fraudulent, courts are just unsympathetic.
Highly unsympathetic. Courts have repeatedly rejected attempts by borrowers to recover losses from a subsequent fire sale, arguing the borrower failed to fulfill the prerequisite of tendering the debt. It just solidifies the power of the institutional creditor against the individual property owner who's trying to get redress.
So, assuming the house is gone, the auction block is cleared, the financial consequences for the borrower, they don't necessarily end there. This brings us to the dreaded deficiency judgment, and this depends entirely on whether the debt is recourse or non-recourse.
A deficiency judgment is the lender's mechanism for clawing back the remaining loss. If the property sells at auction for less than the remaining mortgage balance, so the borrower owed $300,000 and the house sold for $250,000, the court may enter a deficiency judgment for that $50,000 difference against the mortgager.
And that $50,000 is no longer secured by the house. It's now a personal debt.
Correct. It transforms into a separate, unsecured judgment, which creates a lien on the borrower's other assets. The lender can now pursue collection efforts against wages, bank accounts, any other property the borrower might own.
This is where that distinction between recourse and non-recourse debt becomes a critical lifeline for a lot of homeowners. What makes a debt non-recourse?
Non-recourse debt legally prevents the lender from pursuing the borrower's other assets to get that deficiency loss back. They are limited strictly to the collateral, the house. That's it.
And is that common?
In states like California, original purchase money mortgages, the loan you use to buy your owner-occupied home, are often automatically non-recourse by state law. The lender just accepts that loss as part of the risk of the loan.
But the sources warn that refinancing completely changes this equation.
It's the biggest trap. While your original loan might be non-recourse, if you refinance the property or take out a home equity line of credit, a HELOC, those new loans are often recourse debt.
So what does that mean in practice?
It means if the property sells for less than the debt, the borrower is still personally on the hook for any deficiency on those refinanced amounts. The average person doesn't realize they've lost that non-recourse protection just by consolidating their debt.
And speaking of other debts, what happens to the junior lands? The second mortgages, the HLOCs, the HOA fees, they were wiped out by the primary foreclosure. Are they just gone?
The lands on the property is gone, yes. If the foreclosing land is senior, all junior lands are extinguished from the property's title. So the bank that held the second mortgage is now an unsecured creditor. They no longer have collateral.
But the debt isn't gone.
The debt is not gone. They have to decide if they want to sue for a personal deficiency judgment against the borrower. If that second mortgage was also recourse debt, the borrower still owes that balance, but now the second lender has to fight for payment just like any other credit card company or collections agency.
And if the lender decides, you know what, it's too expensive or too difficult to pursue a deficiency judgment, the IRS might step in.
That's the complex tax consequence. If the lender chooses to forgive the remaining debt, that $50,000 difference, that amount may be considered forgiven debt by the IRS.
Which is then potentially taxable as income to the borrower.
Right. So you lose your house, and then the federal government sends you a tax bill for the debt you couldn't pay in the first place.
Before reaching this catastrophic outcome, many homeowners try to find alternatives. What were the mechanisms widely available after 2008 to avoid the final option?
Well, historically, things like refinancing were key. especially programs like the government-supported Home Affordable Refinance Program, ARCP, which was designed to help homeowners whose property value had dropped.
And short sales.
Short sales, exactly, where the lender agrees to accept a sale price that's less than the total debt just to avoid the cost of foreclosure. And of course, you saw foreclosure prevention services offering fast cash sales pop up everywhere to help homeowners bypass the legal quicksand.
After the 2008 crisis, the focus really shifted to loan modification, where banks would renegotiate the terms. But the data on how often banks actually agreed to modifications is, well, it's pretty startling.
It's profoundly disappointing data. A Federal Reserve study from 2009 looked at seriously delinquent borrowers and found that only a tiny fraction, a mere 3%, actually received a modification or a successful renegotiation.
3%.
3%. And this was regardless of whether the loan was securitized and sold off or held by a single bank.
Why the massive reluctance? I mean, wouldn't a modification seem economically smarter than a long, costly foreclosure sometimes?
Well, one theory from the sources points to internal bank modeling. The banks often expected to make more money through foreclosure than through modification. They feared redefault, that the modified borrower would just miss payments again soon, or something they called self-cure, meaning the borrower might eventually recover and pay without the bank having to give up anything.
So foreclosure, even with the costs, was a more predictable and quicker financial recovery for them than the uncertain risk of modification.
It was a known quantity. And this inherent distrust and profit motive led to one of the most ethically questionable practices that emerged during that time: dual tracking.
Dual tracking, what was that?
Dual tracking was truly corrosive to the borrower's trust. Lenders would assign one department and negotiate a loan modification with the homeowner, giving them the impression that a solution was right around the corner.
Why?
While simultaneously, another department would be moving full steam ahead with the foreclosure sale process.
So the borrower thinks they're saving their home, only to get a letter saying the house was sold last week.
Exactly. Borrowers were just blindsided. They believe they had a tentative modification agreement, they're gathering final paperwork, and then they find out their property was sold at auction. This practice was so egregious and so misleading that several states felt they had to act. California, for instance, enacted the Homeowner Bill of Rights in 2013 specifically to prohibit dual tracking and try to provide some basic fairness during negotiation.
We spent a lot of time dissecting the legal machinery, but we need to pivot now to the human cost, because the socioeconomic impact of foreclosure is immense, and as the data shows, it is not evenly distributed at all.
The statistics are clear and painful. Foreclosure is a profoundly inequitable event. Minority households are grossly overrepresented. Our sources confirm that African American buyers are 3.3 times more likely than white buyers to be in foreclosure.
3.3 times.
Latinos are 2.5 times more likely, and Asian buyers are 1.6 times more likely.
That raises an important question. What do the sources suggest are the underlying factors causing this disproportionate impact? It's not just about being in a minority group.
No, it's a combination of systemic issues. A large percentage of these groups were disproportionately targeted and steered toward risky subprime loans during the housing boom, even when they could have qualified for prime loans.
And on top of that,
you have the racial wealth gap, which means these households often have fewer financial buffers, less savings, less family wealth, to absorb an unexpected shock like a job loss or a medical emergency. It just makes default inevitable.
And speaking of shocks, what were the primary personal reasons people cited for default?
Beyond job loss, studies consistently point to severe medical conditions and the lack of comprehensive health insurance as a primary reason for default. A major health crisis often results in massive debt, which forces homeowners to choose between medical care and mortgage payments. It just highlights how financially vulnerable so many families are to unexpected health costs.
Now let's look at the financial fallout. We know the credit score takes a hit, but how bad is the immediate damage compared to just being late on payments?
A finalized foreclosure is a catastrophe for your creditworthiness. It typically results in a credit score reduction of 85 to 160 points. By comparison, being 30 days late, while bad, results in a smaller reduction of 40 to 110 points. Foreclosure makes future borrowing, for years, virtually impossible or extremely expensive.
And beyond just the finances, a 2011 Federal Reserve Board study tracked household stability post-foreclosure, and the findings about family life are really revealing.
Yeah, what's fascinating here is that the disruption goes way beyond just the address. The study found that only 17% of individuals who went through foreclosure maintained the same number and composition of household members 1 year later.
Only 17%. Compared
to 46% of a control group. This suggests foreclosure doesn't just disrupt housing, it forces the rapid breakup or drastic reconfiguration of the family unit itself, maybe through divorce or having to move family members out to live with others.
And what about the actual physical movement? How common is it to relocate? And do people generally end up in significantly worse conditions?
Relocation is very common. The study noted 23% of those experiencing foreclosure moved within a year of the process starting, versus just 12% in the control group.
But there was a slight silver lining.
A slight one. The study found that the majority of these post-foreclosure migrants did not move to what they defined as substantially less desirable neighborhoods, so areas with a 25% lower median income. About 70% managed to stay in similar economic conditions, which suggests some resilience, even though they lost all their home equity.
The impact of a single foreclosure also ripples out into the entire community, leading to what analysts call negative externalities. What are the measurable effects on a neighborhood with high foreclosure rates?
Well, the effects are immediate and visible. When foreclosed homes become vacant and abandoned, they attract crime and theft. They're often stripped of copper wiring, appliances. You see trash accumulation, and sometimes an increase in localized illegal activity like drug use or prostitution, which really destabilizes the immediate surrounding area.
And financially, it just drives down the value of all the surrounding properties.
Yeah, absolutely. It creates a devastating domino effect. Foreclosures negatively impact neighboring housing sales, leading to these significant declines in property values that just extend the housing crisis beyond the one defaulting borrower. Research shows this negative impact is greatest when the foreclosures happen closer in time and physical proximity to the homes trying to sell. The blight is contagious.
And finally, we have to acknowledge the psychological and mental health toll of losing a fundamental source of security and wealth.
The mental health crisis is measurable. One study of participants who had undergone foreclosure found that a staggering 36.7% met the screening criteria for major depression.
Over a third.
And it's not surprising, given the stress, the shame, the loss of control. Furthermore, for the children involved, the forced instability often means changing schools, and studies show these students, on average, enter schools with lower overall performance and test scores than their previous schools, potentially impacting their long-term education.
Let's broaden our lens now, starting with some of the U.S. macro trends that emerged after the 2008 collapse, and then we'll move into the global context. In 2009, when the U.S. housing market was just melting down, there was this big political fight over how to fix it.
There was consensus that intervention was necessary, but a total disagreement on the methodology. You saw a stark divide.
What was it?
Democrats generally advocated for targeted aid aimed directly at people in the greatest distress, so helping delinquent homeowners modify their loans. Republicans, on the other hand, favored broader aid aimed at stabilizing the whole housing market by supporting almost all home buyers.
The rising tide lifts all boats theory.
Exactly, and this disagreement just paralyzed any truly aggressive unified action for a while.
Despite the debates, by 2011, the banks seemed to revert to their old aggressive habits.
They absolutely did. By 2011, banks became extremely aggressive in their recovery efforts. They were set to repossess over 800,000 homes. They sped up the foreclosure process, recognizing the legal efficiencies they had, especially in those non-judicial states.
And looking at the data from 2010, the foreclosure crisis wasn't spread evenly, was it?
Not at all. The highest filing rates were clustered in the metropolitan areas that had seen the biggest housing bubbles, places like Las Vegas, Fort Myers, Modesto, and Miami.
What's fascinating is the complex correlation between unemployment and foreclosure rates. I mean, logic would suggest high unemployment equals high foreclosure, but that wasn't always the case.
That's a key insight into the market's complexity. Some cities with the lowest rates of foreclosure, like Rome, New York, or Tuscaloosa, Alabama, actually had some of the highest unemployment rates in the nation.
So what does that tell us?
It demonstrates that job loss isn't the sole driver. Foreclosure is driven by the combination of job loss and excessive debt that was tied to inflated asset values. So areas where debt loads were lower, even with high unemployment, sometimes fared better.
Regardless of the nuances, the crisis continued well into the middle of the last decade.
Indeed. By August of 2014, the national foreclosure rate was still stubbornly high at 33.7% above baseline, with significant increases concentrated in those densely populated, high-cost areas like New York, New Jersey, and Florida, where the judicial process just added more complexity and delay.
Okay, let's leave the U.S. system behind for a minute and look at the international contrasts, because they show radically different philosophies on how to balance debt recovery with homeowner protection. Let's start with Spain. which offers arguably the harshest outcome.
Spain's system is brutal in terms of debt liability. In the U.S., the foreclosure sale often settles the debt, especially if it's non-recourse. In Spain, the homeowner remains responsible for the full amount of the loan, plus all accrued penalty interest and court fees, even after the bank has seized and sold the house.
So if they have a deficiency, a shortfall, that debt is essentially a life sentence.
It can be. Bankruptcy is explicitly excluded as a resolution for mortgage debt in Spain. This means foreclosure often marks the beginning, not the end, of the borrower's financial trouble. It can initiate a lifetime of debt obligation to the bank, which is particularly devastating given Spain's historically high unemployment rate in the Eurozone.
Okay, so let's move to the United Kingdom, which has a much stronger emphasis on consumer protection.
Right. The UK uses a system of mortgage possession rather than true foreclosure as we define it. If the property is sold and there's a surplus, the consumer gets those funds. More importantly, if there's a shortfall, a deficiency, the remaining debt typically becomes unsecured. Meaning if the borrower enters bankruptcy, that deficiency is treated the same as any other unsecured credit, like a credit card bill. The borrower doesn't face that crushing targeted deficiency judgment that can follow them for decades.
And the UK system also mandates collaboration before even going to court.
Yes, the UK system requires lenders to adhere to strict pre-action protocols. Mortgage companies must actively work with homeowners to find resolution payment plans, modifications, before they're even allowed to initiate formal court proceedings. This forced delay and negotiation is designed to help borrowers avoid losing their home entirely.
Now, moving to maybe the most protective model globally, New Zealand, where the very concept of foreclosure is prohibited by law.
It's a complete legal inversion of the U.S. system. Foreclosure is prohibited. Instead, lenders realize their security through a statutory regulated mortgagee sale. And critically, the lender never actually gains the fee simple title. They only gain the right to compel the sale under specific legal oversight.
So it removes that whole U.S. objective of terminating the equitable right of redemption.
Exactly. It ensures the process remains consumer-focused and highly regulated.
What about China? With such a vast and rapidly developing market, how do they handle mortgage default?
China uses a strict judicial foreclosure as a debt enforcement measure. However, their banking system builds in these fascinating safeguards to try and prevent defaults in the first place.
Like what?
Things like requiring mandatory secondary security, so collateral beyond just the house, and the maintenance of borrower accounts at the lending bank, which can be automatically used to cover defaults without even telling the borrower first. The judicial process itself is designed to be streamlined, aiming for finalization within 6 months.
And finally, circling back to North America, let's look at the lengthy, owner-favored process in Canada, specifically in Alberta.
Alberta's foreclosure process is famously slow and multi-stepped. It often takes a year or even longer to complete. The courts there have a very strong tendency to favor the property owner over the bank. They're cautious about approving sales, especially if there's any indication the property is being sold below market value.
So the banks themselves actually slow it down?
In a way, yes. Knowing the court's preference, the banks tend to extend the process themselves to make sure they never sell under value. It often turns into a very lengthy, drawn-out negotiation.
This deep dive has really confirmed that foreclosure is not a simple, single event. It is a highly technical, multi-layered process involving specialized contractual clauses, vast statutory requirements that vary wildly by state, and this inherent legal tension between corporate efficiency and individual rights.
It's a perfect case study in how the legal system attempts, and often struggles, to balance the commercial needs of institutional lenders who need to recover collateral to keep the credit market stable with the fundamental human necessity of the borrower to retain their primary residence.
As we've seen, whether you're dealing with acceleration clauses in California, judicial requirements in Florida, or lifetime liability in Spain, geography truly is destiny in the world of debt recovery.
It really is.
Absolutely. The speed and the legal certainty that's afforded to the lender through that non-judicial power of sale is such a stark contrast to the lengthy, formal, and defense-heavy process you find in judicial states. It just shows how much power that initial agreement really holds.
And this leaves us with a final provocative thought for you to consider long after this deep dive concludes. We dedicated time to discussing the paradox of the tender rule in certain U.S. states, requiring the borrower to pay the entire debt just to challenge a wrongful foreclosure.
The ultimate catch-22.
Exactly. So If the only reliable legal defense against improper institutional action, things like fraud or inadequate notice, requires a massive injection of cash that the homeowner almost certainly lacks, does the system fundamentally protect institutional creditors against accountability more than it protects the property rights of the individual homeowner? It's a question worth mulling over as you navigate the complex world where finance meets the law.